Welcome to the Lane Gorman Trubitt Summer Survival Webinar Series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive this summer. Changes to legislature, tax policy, and a business environment that is constantly in flux can make it difficult to keep your head above water. In this webinar, LGT Financial Advisors will provide an economic and market overview with personal wealth planning facts to instill confidence in your financial future. It was recorded live as a Zoom webinar on August 4th, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have any questions, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as possible.
So hello, everybody. I hope everyone is doing well. And let me see here. There we go. And so great to see well, not seeing everyone, but have everyone together and be able to take some time out of your afternoon to listen to this portion of our Summer Survival Webinar Series, Responsible Wealth Creation During Economic Uncertainty. My name is Miller Bentley. I'm a financial advisor here at LGT, and I'm actually coming up on my 1-year anniversary with LGT next week. And coming into LGT before last year, industry experience about a little over 3 years with a larger broker dealer. And so it's been great being on board here with our partner in charge, Scott Gunn, who is the head over the financial advising team. He's has over 25 years of experience and joined LGT in 2009. So what we're going to be doing today, I'll kind of walk through the agenda real quick. The first, we're just going to go over kind of an economic overview, look at some visuals from various trends that have kind of led to our current situation in the economy. We're going to I'll highlight some recent events and volatility and how this could shape the future market and the economy, and how those movements can kind of lead into then your wealth creation and ultimately affecting your financial plan. And we'll go into some high level, but what I consider very necessary kind of reminders for some, but it might be some new information for some as well, just applicable, proven financial strategies that to help weather the storm during these really uncertain times, during especially now the coronavirus pandemic and how that's affected just about every aspect of life. And like I said, we'll have time for questions at the end. So the first section that we're going to get into is just a little bit of an economic overview here. And so just about 1 year ago, the U.S. business cycle phase in 2019 in August, everyone had really pinned us being in the late phase. And some would call that as well the contraction phase, same wording there, but it was happening globally as well. Now, China was a little bit ahead of us, but everyone seemed to be kind of what a lot of people were referring to as kind of the ninth inning of the bull market territory. And just a brief explanation, typically there's an early business cycle phase with growth, and that can typically be the longest, and that's what actually we were in for a little over 10 years. And then we have the peak, and then we get into the contraction phase, and then it can be what some refer to as the recession or the trough of the business cycle. So it was a little bit abnormal for us to be where we were even last year. I mean, over 10 years where we were in a kind of a long bull market, and then we took the last 4 or 5 years kind of in this late phase. So it had been extended, and what that really is characterized by is kind of the peak economic activity, which it might seem a little bit strange for the peak to be in the late portion of the cycle. But as we've seen, there really hasn't been a whole lot that has been 100% normal and continuing historic trends throughout this pandemic, as well as tighter labor markets, pressure on earnings, and then a flattening or maybe an inverting of the yield curve. And that's what we'll get into next. So on this slide, this is the U.S. GDP growth rate, gross domestic product over the past just about 3 years. And so we look here, we're looking at peak economic activity, specifically in 2019. Now, it was actually determined by the National Bureau of Economic Research that the peak economic activity quarter happened in Q4 of 2019. But the peak economic month during that same time frame, during that same roughly 10-year bull market period, the peak month was in February. And usually that is quite unusual. Usually the month and the quarter are in the one and the same. But this time the month, February of 2020, was determined to be the peak economic month during that kind of late business cycle phase. And then the Q4 of 2019 was actually the peak quarter. And so they can be one and the same because we hadn't moved into a new business cycle yet. That month of February is still characterized being in the late phase. And although the growth rates weren't tremendous, in between the 2 to 3.5% for the majority of it, it wasn't necessarily uncommon because we haven't seen GDP growth over 5% since before 2000. So it's been a little while for these rates to really be rising dramatically, but the consistency has been it's been consistent throughout this entire time. On the next slide here, we're looking at the unemployment rate. And so this is kind of getting back to the tightening of the labor market. So what we're looking at here is the unemployment rate for the past 20 years. What we're kind of focusing on is these last 5 to 10 years, specifically the last 5, where the unemployment rate has been right around target, anywhere between 3.5% to 4.5%, and declining since the last recessionary phase. And that's what we're looking at here with the gray shaded areas is what's been determined to be the recession time frame. And that'll be the same for a few of these charts going forward. And so just a little peek back a year ago, August of 2019, the 4-week average for initial jobless claims for unemployment insurance was right at about 216,500 for the 4-week moving average. So keep that number in mind, and we'll revisit that again when we look at these rates kind of going forward. And then we're getting into the U.S. Treasury yield curve, and I'll come back to this, but the main thing to notice here when we're looking at it is the flattening or in this case inverting of the yield curve. And that's just 1 year ago, actually in August of 2019, it was inverted. And we'll get into more detail, like I said, but this is, again, another characteristic of the late business cycle that our economy was in just a year ago. So we'll get into the kind of a closer look now, a brief overview of the markets, the broad markets, equities, and fixed income. So just like I said, a year ago, and what we were looking at, that we were pretty much characterized by low, consistent interest rates. There wasn't a ton of fluctuation that was going on, but in the grand scheme of things, they were somewhat low, and that was across the board from loan rates to certificates of deposit to invest in or bonds. Most rates they were becoming smaller, but pretty much remaining consistent. Again, we had been in a over 10-year bull market even last year, and that really started to emerge in 2009. And we were beginning to see quite a bit of volatility in the equities. And that was, again, across the board. Most sectors in different indexes were having extreme volatility, at least at one point in the past 5 years or so. And then as well, I'll touch on this, but the price of oil was increasing. The increase in demand, which kind of paints a broader picture. There were some increasing trade tensions and high tariffs that were happening in these past 5 years that did have an impact on that. And the price of oil can be used as a little bit of a market indicator. And I'll touch on that here. So the first is the federal funds target rate, and I'll explain why this is important. So the Federal Open Market Committee of the Federal Reserve Board sets the funds rate, the federal funds target rate. And so what this means is that banks, they have to maintain a reserve with the Federal Reserve Bank to cover withdrawals and various obligations for their depositors. And that storage is non-interest bearing payment. So the money for the bank is just sitting there. And so if that bank has an excess in their minimum requirement at the Federal Reserve, then they can lend out their excess to banks that might not be meeting their minimum or might not meet their minimum. And so they can lend that money out at a specific interest rate, so it starts working for them. So this is the Fed funds rate is what that refers to. And so if the rate is high, the bank might try to loan more money, maybe keep a little bit more money sheltered in the Federal Reserve. It's less risky that way. And if the Fed funds rate target is low, then essentially banks are going to keep only as small amount as possible in the Federal Reserve excess, because they can have better rates through their own loans. So the Federal Reserve itself cannot set these specific rates. They set the target, and then they can use different tools to essentially kind of force that rate into effect. And one way they can do that, as an example, is by injecting money for more consumer use. And so that can then increase rates. And what I want to focus on in this chart is where that arrow is the broader picture for the past 20 years you can see here, and you can see the overall trend being that typically lowering rates can quickly turn into a economic recessionary period. You can see from about 2015, which is when the Federal Reserve started raising those the Fed funds target rate. And then back in August of just last year, where the arrow is where the Federal Reserve started to kind of stair step down their rates. And essentially, they were trying to kind of curtail the effects of the pending recessionary period. And history has shown that those rate cuts, and you can even see here, they haven't done a whole lot to prevent that. And moving on to now the U.S. Treasury yield curve, what I was referring to earlier. So On the top of this, the light gray is August 2018. Middle or darker gray is August of 2019, and then the bottom, the blue, is current August of 2020. And on the left-hand side of the screen, there's by drawing the orange, typical, or not necessarily typical, but kind of the preferred yield curve. And so essentially this is the U.S. Treasury securities that, shorter term, as you can see kind of on the left-hand side, 1 month, 3 month, those are short term. They're lower risk because they are shorter term. So in return, they typically have a lower interest rate associated with them. And then, that makes sense. The longer term, then they have a little bit more risk. They have interest rate risk. And so they have a little bit higher of an interest payment. And so what we saw, and what this indicated when the yield curve inverted, was that essentially the stock market, the equities, broad market, the sentiment was low. And so what there was a transition to was purchasing of the highest paying, most conservative, or least risky securities, which are U.S. Treasury backed securities. And so when those purchases and the demand goes up for those long-term treasuries, looking at the 10, 20, 30-year treasuries, when the demand goes up, then the prices increase, and essentially that lowers the yield. So investors were fleeing to these lower interest rate potentially, but the highest interest rate that they could receive for the safest treasuries. But they were fleeing to those, and essentially they were satisfied with the knowledge of receiving about anywhere from 2 to about 2.5 to 2.75% interest, as opposed to having their money invested in the stock market. And it was an important event because of the past 9 recessionary periods. All of them were preceded by at least one inverted yield curve. Now, the most time it took between an inverted yield curve and the recessionary period to hit was about 34 months. So that was kind of a long one, whereas this was just not even 12 months before we saw what we saw in February and March. And what we're going to look at next is this is the S&P 500 index chart for the past 10 years. And the S&P 500 index, it's an index just measuring pretty much the 500 largest publicly traded companies. And so in a very basic description. And so you cannot necessarily own the index, but there are investment options that can mimic the index. And so it's a broadly used kind of index to get a gauge on where the markets are, as well as the Dow Jones Industrial Average is another index as well, and the NASDAQ. And so what we're looking at here over the past 10 years is we've seen overall positive trends. For about the past 5 years, you can see that the volatility has increased. You'll see those larger up and down swings. And then we're in about the 2014 to 2016, there was a little bit of stagnancy, but still growth, just not as apparent. And that's 1 year to kind of remember here is right at the middle to late of 2014, where we surpassed on the S&P 500 the 2,200 mark. And I'll mention that again, but that's kind of an important date just when thinking about the grand scheme of investing and where we have come from. The next is a zoom in, taking a a closer look at just now the past 5 years of the S&P 500 index, and specifically looking at the market swings in 2018, showing the volatility, large swings, and then almost all of the indices during this period hit all-time highs during 2018 specifically, but they all pretty much ended negatively, as you can see in that second circle. And then the arrow here is pointing roughly to when last year the Federal Reserve started kind of decreasing, stair-stepping down those interest rates. And the main thing to note here is even through all of the trade tensions that were going on, we had Brexit, there was an election, and just alone in 2019, just looking back for 1 year, the S&P 500 index was up over 30% return. So although it was marked by extreme volatility, and even these 5 years specifically, there was a large amount of growth that happened. And then again, just touching on the price of crude oil, and this is a chart that shows the price, which is on the left side of the graph, and the blue bar, and then the S&P 500 index kind of overlaid on that with the orange bar and the index on the right. But again, this is just some viewed as a large indicator for the economy and the market outlook. It is a tradable commodity, and so it's also a globally traded resource. And so the price of oil for some can be an indicator for trade tensions, where we are with tariffs and things like that. And so it is correlated to the broad market, as you can see, but also you can see where kind of the price was teetering lower even as before we got to our major recessionary phase. So now let's look at our current environment and kind of looking ahead. This isn't to say anything that I have a globe or a crystal ball back here that I can predict the future, but it is nice to look back at the history and see what has happened, and potentially seeing if there's anything, indicators that we can use to potentially look ahead. And so where we are right now, we are have been deemed in a recessionary phase, which is characterized, we've got corporate profit declines, monetary policy that's easing, which again, monetary policy, that's referring to the policies that are put in place by the Federal Reserve Board that they are enacting upon. We're seeing an unemployment increase and inventories and sales that are lowering. Usually this is the shortest phase of all in the business cycle, and that is usual, but like I said, we're not necessarily in a usual business phase or cycle that really anyone is seeing right now. It is very unique in that our profits have declined. For some, they've disappeared. The GDP pace has slowed down, down 32, almost 33% annualized, just after the recent Q2 release of the GDP info. Again, the federal funds rate target, it's been slashed to 0 to 0.25%, and it has been almost promised that it will be there throughout 2021 as well. And again, unemployment claims have skyrocketed. The week of July 25th, continuing unemployment claims, they were in at 1.43 million. So we'll look at the GDP growth rate for Q3 2017 to Q2 2020. Again, it just shows here how much of a hit the economy has taken. Now, not necessarily in Q2, or in Q1. January and February were somewhat normal. Again, GDP, peak GDP month was February 2020. And so Q2 was kind of what we were seeing the onset effects of everything that has come about since the onset of the pandemic. And again, we're going from February and then March, and March is when the World Health Organization declared officially the coronavirus a pandemic. And we'll look back at the federal funds target rate, where they started in August of last year to kind of stair step those rates down to about 0.25%. They were being stair stepped down pretty slowly. And March 3rd of this year, the Federal Reserve cut the rates at about 0.5%, which you can kind of see there in the chart. And then March 16th, which was a Sunday, which again just showed how serious the Federal Reserve was about this recessionary period and how much they were intent on curtailing it. On a Sunday, which is very unusual for them, released their target rate of 0%. And so not only has the Federal Reserve Board slashed these rates, they've opened up various lending and purchasing tools to increase the money supply that's going on, increase money that can be used. And so far, it's been over about $2.3 trillion of lending support that the Federal Reserve, that they've been able to go into their toolbox. And what we're looking at here is, on this chart, is the months after peak employment. So again, we were looking at February. These unemployment rates were so low. Again, 1 year ago for the August, the 4-week moving average for unemployment claims was 216,500. Last week's report, the 4-week moving average was almost 1.4 million. In the peak in May, where we saw kind of the lowest initial unemployment claims, this chart only goes down a little past 14%, but it was right at 17%. And so by late April, there were over 22 million jobs that were created since the 2009 kind of spur of growth that had just been wiped out within a 5-week period, just through April. And the unfortunate news here is that we're back to initial unemployment claims rising again. They were up to 1.43 million the last week of July, and we're going to have another release. These are released weekly on a Thursday, and we have seen these now for 2 weeks straight. They are back on the rise, and the continuing claims, which is not the initial claims, but individuals coming back and claiming unemployment again, they are still unemployed. They were on an 8-week decline, but they are up again, and up. That's been to 17, just over 17 million, and the unemployment rate currently is around 11.6%. So what this graph shows is historically, just for a few of these years here, how many months it has taken to get back to these peak numbers, but essentially these low unemployment numbers again. Again, we have a long way to go here, and you can see just how deep these are compared to 1974, 1981, 1990, the 2001 crash, and then 2008, most recent. And 2008, you can see how long it took to get back to those numbers, and we've seen the chart as well before this. It did take a long time for recovery, and you can see, unfortunately, that unemployment rate wasn't as low as it was currently. I mean, these are historic numbers that we're looking at. And so, again, just looking at now some kind of investment strategies, or again, getting back to somewhat of wealth creation here. If you're looking at specific stocks or equities, there are strategic sectors that can be allocated to. But there is what we believe going to be a lot more volatility ahead. If you can kind of grasp that in Q1 of 2020, the S&P 500 ended up down almost 20%. It was down about 19.5%. But then Q2, it came back and was up a little over 20.5%. And so that is just an index based on stocks alone. And so there's a lot of risk involved. But if you look at these various industries that have kind of emerged because of the COVID-19 pandemic, and what has kind of shown itself to be, a sector that can yield itself very usable when businesses start to position to or pivot to working from home, working remotely, maybe cutting their the time that's needed in the office. Obviously, the IT area has grown tremendously over the past year, specifically hardware and storage industry, which is cell phones, computers, servers, and data storage components. The consumer discretionary industry has increased almost 20% over the past year. And specifically in consumer discretionary, though, it's the manufacturing segments like household durable goods. Consumer discretionary also includes, outside of the manufacturing segment, kind of the entertainment or the kind of excess consumer discretionary, and that section has not necessarily performed as well as the household durable goods. So, and then another one to highlight is healthcare, where obviously they are in an incredible position right now, just with the amount of stress and work that's going into healthcare as a whole. Biotechnology and equipment and supplies is where there has been growth, and there seems to be almost no end in sight for that growth, as well as demand. Energy has definitely taken a hit, and as you can see with the oil prices, it could take a while for oil to return again. Going back to these uncertainty that has come along with the coronavirus. Looking at fixed income, low yields, the 10-year yield is roughly about 0.5%, and it's down about 1% from last year. And like I said, the Federal Reserve has promised almost guaranteed low Fed funds rates through 2020, through 2021 as well. And what that has shown is that although the safer Treasury-backed securities might be low as far as the interest rates and earnings, this also can kind of lead to other fixed income opportunities where corporations, while they might be struggling right now, if they're a big corporation, a lot of the talk and what's going on right now is where these large corporations, their debt, where what they use to raise capital, is being downgraded from not as investment friendly. They're saying, the raters are saying that it's a little bit riskier, and so these are showing a bit of a buying opportunity potentially at the right time for companies that have been downgraded, but in the long term they have a better chance of survival than others. And again, there's a lot of uncertainty, there's a lot of volatility, and right now it might not necessarily be the best time if there was a lump sum of money to go in and make a big purchase in one specific company or one specific sector. But we'll touch on what we like to sometimes use, responsible dollar cost averaging. But it might right now, unless it's at an all-time low or getting to a low for a specific company, going all in at this point might not be the best option because there is most likely going to be quite some more volatility ahead. Again, the oil prices are fluctuating. 2020 is also an election year. With that, of the past 23, only 4 have resulted in a negative market return. And again, the uncertainty here, what I'll kind of refer back to is when we were looking at the S&P 500 chart in August of 2020, it first broke through the 2,200 point. And we didn't really get back to that 2,200 mark until 2014. So almost 14 years later, we were back at that point. And then we were essentially breaking new records each time, each month after that. So it's a lot of uncertainty that we're going to be faced with here going forward. And so we're going to look next at, again, just kind of these tips. And like I said, it might be old news for some, it might be new news for some, but these are points that during these economic uncertain times, these times of extreme volatility where there's not a whole lot of a settling feeling that comes over you when you're looking at your finances right now. These are some tips that we like to keep in mind. So we realize that not everyone has a professional advisor. That's just not feasible for everyone to do that. We recommend it, but a lot of people can also do this on their own. And I like to kind of go back to 3 things that really the financial plan and managing your own wealth creation should include, and it has to include really for it to function properly. And you have to be able to dedicate your will, skill, and time to kind of do this correctly and make sure that essentially when you want to retire, you can retire, and you can retire on your own terms. And so what to look for when you might be doing this by yourself, and things to look for right now is, right now these low interest rates, it is a low interest rate environment, and so there's a lot of savings that could potentially happen. You're looking at loans, speaking of mortgage loans that could potentially be refinanced, or if you're in the market to purchase a house, while there are some upfront costs, there are good ways to look at break-evens and be able to determine the long-term savings that can really have an impact on your financial position down the road. Looking at, I've heard it time and time again now with people not, at least for the first few months, driving as much, looking at their car insurance, different insurances that could potentially have lower premiums now that they might not be they might not be utilized as much as they used to before, when we were potentially driving to work every day, and now you're still at home or only going in a few days a week. For life that has changed like that, there are ways to look at specific savings. Also looking at expenses, keeping track, just keeping track of your expenses can be an easy step 1. It's essentially kind of how to accumulate your freedom in retirement. If there's expenses that are happening right now that maybe made sense before the onset of the pandemic, then maybe take a look at those and reassess which might be necessary to keep going and which could potentially be cut out. The next is ensuring self-care, and that's a large stress point. We are in a pandemic, and so we essentially want to make sure that you and your loved ones are cared for. Taking a financial perspective on that, So are you needing to add new expenses for self-care? You might not be getting out of the house as much. What could potentially help with that? What can, make sure that you are living your life to the fullest currently? Uh, if you live far from family, what does that family time look like now? Is it, maybe needing to invest in a computer for better FaceTime quality, or just various things where it's good to reassess these things and take an actual look at them, rather than, if they are a burden, just letting them kind of fester. And then the last is protecting your monetary legacy, and it's specific. Use a specific terminology of monetary legacy, because this isn't. No one beside yourself can really help protect your own legacy. So this isn't what your family will remember you for, but it can absolutely tear them apart after the fact if it's not handled properly right now. And so it's an easy process to do. Make sure that you have beneficiaries set up. Again, this is good information and good steps to take from even those who are just now starting out in the workforce to those who have potentially been out of the workforce for years. Make sure that you have beneficiaries set up and on your accounts, and have a will in place. Even a basic will will do. And medical and durable power of attorney, so that if something were to happen to you, you are taken care of, and those decisions are made from someone who you love and trust. Make sure that your executor or executrix is established and they know what's going on. Someone that you love and trust, that can essentially make sure that your monetary legacy is left in the status that you intend. The next thing that we like to look at is when we get into investing is understanding that any type of investing involves risk, and risk isn't just the bad. Risk is also the good. There can be, if returns exceed expectations, well, then that was an unexpected risk that was taken. And so when you are investing in stocks or specific companies, there's more risk. You're more centralized to that specific company. And so because there's more unknowns, whereas if we are looking at more interest-bearing or fixed income securities or investments, there's typically less risk, and because there are less unknowns. There's typically an interest rate that is guaranteed or assured, and there, what's backing that and how much you can depend on that. So in order to assess that risk tolerance and be able to essentially feel more comfortable about your financial plan, it's good to look at these three items, the three T's. First is the time frame. When do you need these monies that you saved? You can typically categorize these into, I like to keep it simple, into about 3 different time frames. First would be less than a year, really short term, usually cash, pretty liquid. Intermediate term, that can vary over 1 year, up to 5 years or so, maybe 10 years, and you might have a couple different buckets. There might be some education savings that you want to save a little bit more for. Maybe if you have want to save for a big expense coming up, maybe say a new car or maybe a new home. There are intermediate timeframes that can be used for those savings. And then the long term, which I typically just refer to as retirement. And so typically, like I said, the shorter term, that's the least risky that you want to have those funds, because you rely on those, you need those in a short time frame. Your tolerance, essentially, this is kind of what can you stomach? We've had so many fluctuations over the past 5 years in the stock market alone. Even if your plan was, it included 100% stocks which is not ideal. If you can stomach that and you realize the risk that you're taking, then so be it. But there's definitely a lot of confidence and trust that has to be had in your plan in order to be able to stomach those large gains and those large losses potentially. There's a lot more risk involved. So even though you might think that you are one tolerance level, it's good to reassess that and look at it and think, okay, well, I've seen some large fluctuations over the past even year. What did I do, or what might I have done if they had been this, if the losses had been this large? So it's always good to kind of reassess that. And the last is taxability. And retirement accounts, typically they're tax deferred for long term. So typically they can be a little bit riskier. Again, there's typically a longer time frame. Unless you're close to retirement or in retirement, that would then be considered short term. And so you'd want to make those less risky. The brokerage or taxable accounts, that can add to your long-term or short-term capital gains in your taxes for the year. And so will this affect your expenses? What steps are you taking to protect yourself from excessive taxes that could ultimately lead to higher expenses in the future? The last thing I'll touch on here is that you'll see that there's one of the T's is not timing. Timing the market, it's pretty much a lose-lose game. You'll notice there that the peak or the bottom, they're really unknown until after that time has passed. Peak economic activity for Q4 and for February of 2020 wasn't even declared until June of 2020. So if your plan involved, buying at the bottom or selling at the top, it's a lose game when you try to time the market. And so we always like to hinge that time invested is much better than trying to time your investment. And so a good comparison here is if there were two investments at $10,000 each in the year 1950, but one of those, that $10,000 lump sum, missed only 10 of the best trading days since 1950. And as of this year, there'd be a difference of over $870,000 just from missing 10 of the best trading days with an initial value of $10,000. Your annualized return fell over a percent, from about 7.5 annualized percent to 6.2%. So again, time invested is much better in the long term than trying to time your investment. Again, allocating intentionally and within your tolerance, there's no reason to go outside of your tolerance bands, outside of your own, again, what you can stomach. If you've prepared properly and you are aware of your range, kind of your band of what your money can make and also what your money can lose for you. And so if you do that intentionally, it's much easier to overcome those emotional decisions that might come when the market is so far down, when your portfolio, if it's addressed and allocated appropriately, it'll be within your own tolerance levels. And again, the dollar cost averaging, it is a strategy that can be used, and I like to precede that with responsible dollar cost averaging, because again, time invested, time in the market is more beneficial than trying to time it. And not that dollar cost averaging is timing the market, but if that money is sitting on the sidelines waiting to be invested over your schedule, then that money is not invested while it's waiting there. So while it might not be a great time to do a lump sum purchase in a specific allocation right now, uh, waiting and doing dollar cost averaging over a year-long period potentially, it can be harmful. Now, that's not to say that you can make that dollar cost averaging, into a shorter time frame, but uh, you know, yes, you will. If you invest the same dollar amount at a specific schedule, then you will most likely purchase, less shares at the higher price and more shares at the lower price. But while you're waiting on all that fluctuation, the money that could have been invested is sitting on the sideline. So again, it's responsible dollar cost averaging, but in a way where you're not waiting too long, but we're not just sitting there and guessing and investing at potentially the peak. So again, these are kind of just some key items here that I like to reflect on, especially in how uncertain these times are right now, that can really make a difference and essentially ease your nerves when there is so much going on and there's so much disassociation between the economy and where the stock market is, that it can make your financial plan and meeting your financial goals that much easier. That is all I have for everyone today. Again, I really appreciate y'all listening to this.
I do have a few questions for you. So, is now the best time to refinance your car, your home, your student loans, etc., because the interest rates are so low?
Well, that's a good question. So the best time might be different for everyone, but especially for mortgages, mortgage rates currently they haven't necessarily been this low in quite some time. So even if you've purchased a home in the past year, the rates currently might be lower than what you have currently. So it could be a great time to do that. Now, one thing to keep in mind, a couple things, that involves a hard credit check, and that also involves some cash up front most of the time. So right now, it can be a great time to do that, but it might not be feasible. I believe there is an article that'll be coming out later this month that I actually kind of go over how to calculate and go through your break even, so you can kind of find out if it's feasible to even do that. And the nice thing is that they'll probably stay low like this for a while. So it's always good to at least keep an eye on it, and be in touch with your bank or your lending institution just to kind of maybe be in their ear, because most of the time they're looking to do this as well. So it's good to at least look into it right now and maybe try to calculate where your break even is.
Thank you. And then I have one other question. So, is it a good idea to withdraw a portion of your investments and keep them in a savings account until the market maybe evens out, or would you recommend keeping those in?
Well, that goes back to the intent of what the funds are intended to be used for. At this point, if you're not needing the funds in a short time frame, under a year, the time in the market is most of the time going to prove more beneficial than having it in cash, if you can stomach what you would invest in, if you can handle a little bit of fluctuation, because again, there will most likely be more volatility ahead. But if you're not invested in stocks or things that are going to be impacted the most by potentially a next wave of more extreme high unemployment, layoffs, companies that are just disappearing. If you're not invested in those specific types of industries, and it's these small fluctuations, then it would make a lot more sense to be able to keep that money invested. especially for the long term. The short term, I always let people know that having an emergency fund that is not invested is one of the best things you can do, because and with an emergency fund, it's completely personal with how much you want to save, but typically anywhere for, if you're a single earner or if you're single, to save at least 3 months salary and a uninvested side just emergency savings account that you try to not even look at. And if there's two earners, then try to save roughly about 6 months. And it's one of those habits that it can be tough to get on top of, but if you can do that and be able to save that money so that in an emergency, you know that you have a little bit of a fallback. You've been building this, it's not invested, it's cash, you can use it for expenses to get back on your feet. And I might even in our current times, maybe stretch that a little bit if you could, 3, 4, 5 months, because it could take a little longer, to find a job, especially, depending on what niche or, where you work or are looking to work, what industry you're in. It might take a little bit longer than usual. So rather than pulling money out and waiting for a better time to invest, maybe reallocate where your savings are going so that you do have maybe a separate emergency savings pot on the side that is safe, and then that your longer term, maybe intermediate to longer term funds are invested and they're getting that time in the market to grow.
Thank you for joining us. As this situation is constantly evolving, please make sure to follow our events page for more information. The link is in the description below, along with other important links, including our social media. If you want to see more of the Lane Gorman Trubitt Summer Survival Webinar Series, subscribe below and hit the bell icon for notifications.